Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. But before we get started, let's engage in a little story time. So, I have had random people email me their spreadsheets about how they're making good money and then they're completely broke, right? Like negative savings, negative cash flow. They're watching these velocity banking videos because it's like, oh my goodness, what do I do, right? And when I'm looking at their spreadsheets and looking at how much money they're making, you know what I'm saying to myself? Your problems are not real. Now, obviously, I don't say that out loud, but your problems are not real. And let me tell you what I mean by that. Because a lot of times, these people have a line of credit but they don't make it their main operating account. So what's the difference between the average American and the velocity banker? Well, the velocity banker makes the line of credit as their main operating account, the moo. The moo. I just came up with that right now. Whereas the average American uses their checking account to be their moo. And just so that I know you're paying attention, write in the comment, my lock is my moo, okay? I know I make you write some ridiculous things like, my name is Tanya. It's about me being a cult leader. But, anyways, so yes, your line of credit is your main operating account. And so what happens is that even if you have like $1 million of lines of credit, right? And you're not using your line of credit as your main operating account, you know what happens? You just get more in the negative. So what do I mean by that? So let's go over the basics of velocity banking. What is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit, aka your MOO, your main operating account. Do I have a cow emoji anywhere here? I got a goat, but not a cow. I got to find a cow emoji. Okay, your main operating account. And so, in order to do velocity banking, it's just two things. Number one is your budget. Number two, you got to get a line of credit, but you got to get a line of credit way before you even start this, okay? But some people have lines of credit before they start this, and then they get into the bank's trap, which is just you make money, the credit bureau share information, and then the banks start sending mailers about how you should get into debt, right? Get that extra, make life more comfortable for you, right? Make achieving your dreams a reality or something like that, something stupid. But that's what happens. And that's why even as you make more money, you just get into more payments of debt. Okay. And so what you do in your expense breakdown is you list every single debt that you have right, right here. 5 credit cards, 2 auto loans, a student loan. And in this example, I think we're a decently paid doctor, 200,000. I think 100,000 is like the amount for a law school loan. And then a $400,000 mortgage. Okay. And then our non-debt expenses, which is our food, gas, insurance, things we also have to pay for, we always have to pay for, gonna be about 3,500 a month. Okay, $3,500 a month. And our whole goal is to get rid of this debt. Now, let me tell you what happens when you use your checking account as your MOO, as your main operating account, right? And what is that? What do we mean by that? Basically, we pay for things out of our checking account and leave the leftover in savings. Now, in this example, there is no leftover. We're literally in negative savings, even though we make good money. Okay. But let's say we had access to something called a line of credit. Now, what's a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. So if I take a look right here, this is my line of credit, my home equity line of credit, $280,000, right? What this means is I can click a button. I can literally click a button either on a bank's website or the bank's app, and they'll dump up to $280,000 in my checking account at a 7.5% interest rate. Okay, 7.5%, right? And so now, let's say I even had access to this $280,000, 7.5% line of credit. And let's say it's even free and clear, which is not going to happen, right? It's not going to happen because banks don't lend money to people who need it. But I've made, a ton of videos about that. So I'm not going to go into that right now. But let's say you did have a $280,000 line of credit, which is essentially like a credit card, but even more flexible because you can use it to pay anything. And then you had a $2,000 emergency. $2,000. Well, what would happen is if you treat your checking account as your main operating account and you pay for things in your checking account, well, let's say the minimum payment is just $50, okay? Then this just becomes -50 to your savings. See? And that's where people struggle when they're watching these velocity banking videos for the first time. It's like, oh my goodness, like that's what I've been doing with my home equity line of credit, right? I just treat it as another payment. Okay. But what we're going to do is we're going to treat our line of credit as our main operating account. Main operating account. So, same thing, same income, same expenses. Okay, let's go ahead and do that. But here's the crazy thing that a lot of people feel uncomfortable with is you're deliberately not going to save money. Okay. So even though we're broke here, the idea that we're still not going to save money is I don't want to know, I don't know if heartbreaking is the right word, but it's very uncomfortable to a lot of Americans. And what's funny is that your average American could even come up with $400 in an emergency, right? Not even $400. Yet when you tell them, I don't save money, they're like, what? How dare you? Like, even though they don't do it, right? Okay. So we don't save money. And so what we're going to do is we're going to increase this thing called cash flow into a negative and a positive, right? Negative to a positive without increasing this thing called income. See, when you're doing things from the average American way, and let me just briefly hide this right now, okay? And you see $12,000 of income, $13,000 of expenses, and you see negative $1,000 of savings, and you even had a line of credit, you're just going to go more deeper in the hole because you're not making your line of credit as your main operating account. When you see things this way, it's like, whoa, I need to make more money to get out of this, right? Because that's what cash flow is. More money over expenses is cash flow, but just by simply redirecting the flow of money, we can increase that negative $1,000. Okay. And this is the part where I'm going to say where a lot of people, especially when they email me and they watch these videos, but just want a little bit of clarification, they realize your struggle is not real. Right. So, what do I mean by that? Well, let's just go ahead and move some debt right into the line of credit. We start off with the credit cards and the short-term loans, right? We start off with those. And if you want a mathematical way to figure out like how do I know which debts to move into a line of credit? Use the cash flow index method. So basically, if you've never heard of it, just go here, right? Cash flow index. And it's just a formula of the loan balance divided by the minimum monthly payment, right? And so that's all we're going to do. Get the balance, right, of any debt that you have divided by the monthly payment, and then you're going to be given a number, 950, and then this one is 35000. Let's see, divided by 1137.5. This one is 33000 divided by 1045. This one is 34000 divided by 1076.67. This one is 45000 divided by, actually I got this auto calculated for the amortized loans. Whoopsie. All right. So let's go ahead and restart this. And so now let me go ahead and do this. Let's speed run through this. But these are what we call our cash flow indexes, right? So basically think of this as a ranking system, and the lower the number, the more bang you get for your buck when it comes to recovering your cash flow, okay? So think about this. Would you pay 35 grand to get $1,000 back in your cash flow, or 200 grand to get 2,000, or $400,000 to get 1,900, right? You want to go with this one because you get a much smaller amount of debt to pay off in terms of, and you get much more cash flow back. That's what the lower numbers mean. So think of this as a debt ranking system of which debts you want to pay off. So this is the easiest way. So let's go ahead and start off with the credit cards, right? And then how much credit card debt is that? 5, 30, 35, 33, 34. Okay. And then that's going to be $137,000 of debt. $137,000. Okay. And so let's say we move that $137,000 of debt. Now, what happens to these payments? And this is the part where you realize your struggle wasn't real. Oh my goodness. How did we literally go from negative 1,300 to $3,000 of cash flow? By simply moving some debt and making our line of credit as our main operating account, right? Our MOO, All right. I just came up with that today well, just in this, literally in this recording, our moo. Okay. All right. So our main operating account. And once you do this, you realize, wow, my struggle wasn't real. I didn't need to make more money. As I made more money, I thought life would get better, and I just got into more debt, and I didn't know what was happening, right? Because that's what the bank wants. They want you here, and then you got to pay those silly overdraft fees, and then that's where they make even more money, right? So, yeah, your struggle isn't real because in order to get from here to here, all we had to do was do the opposite what the bank told us to, which is save money. And if you want to see my checking account or savings account or whatever, you can see that I don't save money, right? I don't save money. And if money comes in and I got some debt, I'm paying it off, right? But the thing is, people are too afraid to pay off the debt, especially amortized loans, because they think, well, once I have that loan and I put that money in, I'm never going to get that money back, right? I'm thinking about this. You're right here, and you're like, well, let's go ahead and overpay some loans. And let's say I decide to overpay the auto loan. Well, how are you? If you only overpay the auto loan, how are you going to pay out these other debts, right? So what we're going to do is make it easy on ourselves to overpay our debt with the help of something called the line of credit. And then the final step is we're going to put our entire paycheck into that line of credit, the entire $12,000, take our expenses out, and then rinse and repeat over and over again. And so by the time each month passes around, our debt is going to be reduced by this number called our cash flow, but we're not going to save money. Okay. All right. So let's go ahead and do this. And I am going to show the magic formulas that people want to know, which is to get the next month's balance. It's the previous month's balance and interest. So that's going to be 3 minus 1 3 minus the cash flow, right? Minus the cash flow because the balance is going to go down by our cash flow. And then I am going to take the average daily balance, multiply it by the interest rate, 0.075 in this case, divide by 12. And then, whoopsie, sorry, I got an alarm going off. Give me one moment. All right, I'm back. All right, so let's go ahead and keep continuing this thing. Okay. Just keep paying it off and off and on. All right. Paycheck in, expenses out. Paycheck in, expenses out. And you see how we didn't make more money, but our debt goes down. But it seems like in this case, when we're making our checking account, our main operating account, our struggle was real. But in this, once we switch our mindset and what we make as our main operating account, our struggle is not real. And we can just easily pay off that debt. And let's go ahead and do that. And we see that in 53 months. Now, remember, we started at a negative $1,000. Okay. 53 months, we paid off our debt. You see how it wasn't real? None of this is. This is the matrix, folks. And a lot of times you see that society is really because they don't, they don't know how to do things. A lot of times it's with a lot of people, it's just a race to the bottom. You ever notice how over competitive most people are and they still suck at what it is that they do, folks? I'm not over competitive at all. I'll share this information for free. Although I do have a paid product or actually that I resell, 20 grand. Click the Google form link below. Give me the money. You know what I mean? All right. So let's go ahead and, how many months was that? Was that 50, 53, 53 months. All right. So 53 months. And how much was that? That's 137K. Ooh, that's a spicy meatball. $137,000 of debt. And we were in the negative. Okay. All right. So let's go ahead and now type in the loan calculator that we have. We literally have a loan calculator, right? And I learned it from the 20K product, how to create this loan calculator. From the 20K product that I sell. Again, the reason why keep mentioning 20K is because I want you to pay me the money, even though I don't need it. And if you really want to, like, does this guy really need money? Well, we all need money, right? But I paid off my mortgage in 2 years and 9 months. So I always have to mention that in order to feed my ego. And you can stare at this and see that I did pay off my mortgage in 2 years and 9 months. It's kind of a weird feeling because sometimes I tell other people and then they kind of blankly stare at me for like a millisecond and then try to, I don't know if it's try to change the subject, but it's like their brain's like does not compute, right? All right, but let me go back to this. Okay, so let's look at the cash flow indexes. Again, we take the lowest ones and we're almost at the end of the loan. Let's take these two loans, pay these suckers off, right? I mean, how much is a auto loan? 5 years. I think that's like 60 months. So there's 7 more months in the loan. Let's take these suckers, okay, and pay them off. And how much would that be? That would be $8,453. And let's get that cash flow back and move it into the line of credit. And then we'll just do this right here, 8453. So 8453.03. And then right, and then this is going to be these two auto loans. Look at that, 0, and then we get an extra 4,000. Well, not an extra $1,000. So now we get $4,000 of cash flow. Okay, $4,000 of cash flow, and then we just got to do this. Update our cash flow number. So this is going to be 4268.17, and then take a look at that. Whoa, we had 7 more months in the loan. Paid it off in 2 months. 1, 2 car loans, all right, at 55 months. That was amazing. Okay, all right, so 55 months, and then this is going to be 137 plus 45 plus 21. This is going to be 203K, and then right, and so now 55 months. Okay, so let's go 0, 0, 55, 55. All right, time to tackle the student loan. So when it comes to amortized debt, okay, when it comes to amortized debt, we do have to care about the interest rate. So the bigger this number is, and the smaller this number is, we don't want to move the thing into the line of credit. Okay, and I'll talk about that briefly. But the reason why is because if we move this $365,000 4% loan into an 8 or 10% line of credit, we're only getting $1,900 of cash flow back. That's an itty bitty amount of cash flow for this huge amount of debt, right? So sometimes we don't want to move the whole thing into a line of credit. And usually the 30-year mortgage is the debt we pay off last because of this number, right? The cash flow index, right? We don't get that much bang for a buck, but eventually we do want to pay it off. It's just we want to pay it off last because I don't know if you know how a 30-year mortgage works. You get to the 30th year, which is 360 months, and bam, look how much interest you pay, $287,000 on top of your loan of 400, right? At a 4% interest, okay? So let's go ahead and move the student loan into that line of credit, and we're going to do that right here. So that's going to be plus 125,323.14. And then how much cash flow do we get for moving it into the line of credit? $2,000. All right, so we did that. And now our struggle is definitely not real anymore, boys and girls. All right, $6,590.34. So we're going to go ahead and do that. And let's go ahead and pay this sucker off. So 6590.34. And let's go ahead and do that. And then we see right here. Well, all right. So, okay. So in 75 months or 76 months, we just pretty much paid it off. And then you could see right here that, so 76 minus 55. 76 minus 55, that's 21 months, right? So in 21 months, we paid off pretty much the rest of the student loan. And how many doctors do you think pay off $125,000 in their student loans in less than 2 years? I don't know, practically none, right? So, like I said before, if I were really smart, I would just run SEO ads on medical professionals and doctors because I know they could pay me my 20 grand that I'm looking for. Pay me the money, right? But it's okay. Even if you don't pay me the money, I'll just stare at this mortgage that I paid off in 2 years and 9 months. Or I could just stare at this where I'm not saving any money, but I see the money coming in. Interesting, right? Okay. All right. So let's go ahead and do something. I don't even know. All right. So let's go ahead and what are we? 70 something months? 76 months. Okay. So 76 months. And yeah, 76 months. And then this is going to be 403k, 403k. Now we're actually going to be a rich doctor. In fact, let's do a Google search on broke doctors, right? Good number of articles there. Some doctors are broke. This one is why are so many doctors broke? Reddit, are today's doctor, quote, the poorest? Doctors going broke. Broke doctors still 3 years from making 350 to 500. Ooh, this looks like a spicy meatball. 8 ways doctors go broke. Uh-oh. Uh-oh. See, if I were really smart, I'd be like doing insane SEO about broke doctors and then just kind of showing them this and say, pay me 20 grand. Okay. That's what I would be doing. All right. So, but I'm not that smart. I'm not that smart. All right. So let's go ahead and pay off our mortgage now. So give me one moment to open the Velocity Banking Calculator. All right, there we go. We got the Velocity Banking Calculator. All we got to do is type in the deets or the information, right? And then it's all there, 3.8 years. So just want to demonstrate one thing. Let's say we moved the entire loan into the line of credit. Look at that. We're paying double in interest. Okay. So we want to pay as least interest as possible, make it easy for ourselves. So what you can do is something called the chunking method, which is you just take a piece of the loan and move it into the line of credit, and then you dump all your cash into line of credit. Very easy, right? And here's the other thing too. You just got to make sure that in general, that if this is a 30-year mortgage, this is the last debt you pay off, because again, for that huge amount you're borrowing, you don't, it's a small payment. But the reason why banks like this is because that small payment means that you're essentially paying double of what you borrowed, right? Okay. All right. So if you don't know, now you know, right? And if you want to know where I got this from Renatus. So if you're interested in not only learning about velocity banking, but also kind of stepping it up a little bit in your financial literacy and real estate investing game, click the Google form link below. But other than that, yeah, that's it for today, folks. So let me put in right here. So 76 divided by 12 plus 3.8. And then that's going to be 10.13 years. We are debt free. And how much debt was that? Let's put 0 here. So this is going to be 403 plus 400. So that's 806. Ooh, that's a spicy meatball. So 806K debt free. Okay. Debt free. All right. Okay. All right. Well, that's it for today, folks. As you can see, your struggle is not real. Have a great day, and I'll see you on the next video. This is Korean Atlanta Mentorship.